Okay, so for this video, we're going to be going through a paper written by Eugene Fama and Ken French. It's called Value versus Growth, the International Evidence. And so before this time, there's been a lot of research on the outperformance of value versus growth, where value firms tend to outperform growth firms. Value firms being those with high book to price, earnings to price, cash flow to price, that sort of ratio, and growth stocks being the opposite. So, but most of these studies have been performed in over the United States securities, and so here Fama and French want to find whether that phenomenon occurs internationally in other markets as well. And so down here in Table 1, we have the summary statistics of the different countries and the stocks we're going to be looking at and throughout the study. And so first we see that here we have 13 countries, the U.S. plus Japan, the U.K., France, Germany, and several other ones here. And in this part A, we have the number of firms in each country. So we see the U.S. has most of the stocks, and this is at the year 1975, 1985, and 1995. The other countries, especially Japan and UK and France, have some high numbers as well. And going down to some more statistics about these the stocks in these countries, we have panels B through E. Minimize this a bit so we can see the countries. Here we have the MSCI country weights. So this is the weight of this particular country in the MSCI's index. And we see that the US and Japan take up a large portion of that index. And so for the next panels here, C through D through E, they've split the samples into high book to market and low book to market. So we can see the market capitalization as well as the book to market ratios that we consider to be high. And so they rank the book to market ratios of all the securities, and the top 30% of book to market ratio companies are considered in the high bucket, and then the lowest 30% of book to market ratios are considered in the low book to market bucket. So we can see here the high book to market ratios would be a bit smaller in average size than the low book to market ratios. And we see that because the value companies, the high book to market ratios, tend to be priced cheaper than the growth companies, the ones with the low book to market ratios. And so here we see the average book to market ratio in the high book to market ratio bucket and the low book to market ratio bucket. So that's a pretty big difference there. So now we understand the data that we're working with. We can start jumping into the study. Okay, so next the authors sorted the portfolios into value and growth categories, and we'll discuss how that's done right now. What we have is book to market, price or earnings to price, UP, cash flow to price, and dividend to price, so dividend yield. And they've got them sorted into high book to market, low book to market. And then the difference between those two portfolios. So this one minus this one gets the high minus low book to market. And that would tell us that if we were to go long the high book to market stocks and short the low book to market stocks, we would result in this excess zero cost return here. So they've done the same thing with high earnings yield versus the low earnings yield gets an excess return. The high cash flow to price versus the low cash flow to price gets us a difference here. And then a high dividend yield minus a low dividend yield gets us this difference here. And so to build these portfolios, they've basically taken the highest 30% of book to market ratio, and this goes for earnings yield, cash flow yield, as well as the dividend yield. But they've taken the highest 30% of book to market companies within each country, and they took the lowest 30% of companies in a country according to their book to market, and then they combined all the countries together according to the MSCI allocation of countries. So if you remember from Table 1, there were weightings of each of the countries in the MSCI that they displayed in that Table 1, and so that's how they allocated each country into each of these portfolios. And these are the excess returns that we get in excess of a T-bill rate. And they have here the average, the mean over annual returns, the standard deviation of those returns, and the T statistic. And then down in this panel B, we also have the returns in excess of the local market. So as an example for the U.S. market, it would tell us where or how much return to this portfolio exceeded maybe the S&P 500 or an index that represents the U.S. market. And then over all of the different markets combined in the way that the MSCI weights each of the markets in portfolios. So anyway, let's take a look at this data now that we understand how it works, and so we can see what kind of information is here. First, we see that certainly there seems to be a value premium in that portfolios of value companies, these with high book to market earnings yield, cash flow yield, or dividend yield, tend to outperform growth companies, and that would be those with low book to market, etc. And they typically outperform the local market's return from 3% to a little over 5%. And in the same vein, the growth portfolios tend to underperform the local market return. So it seems that investing in value companies outperforms the global market portfolio on a nominal basis. And this occurs, you can also, going up to panel A, we can see that investing in value companies significantly outperforms the growth companies as well across the global market. And that outperformance is in each of these high minus low pieces, where it ranges from 5.56% outperformance all the way up to 0.68% outperformance on an annual basis. Okay, so next here in table 3, they've performed the same analysis as in table 2, but they've split it up into the different countries. We have here the global market, or the market for that particular country, as well as the high and low book to market and the difference, the high and low earnings yield and the difference, the high and low cash flow yield and the difference, and then the high and low dividend yield and the difference. Now, if we remember from table 1, the U.S. and Japan together represent about 75% of the MSCI index, and therefore they represent the return, or they weight the returns in from table 2 excessively. So most of the return in table 2 came from just the U.S. and Japan. So now that we've split this into the countries, we can really see how pervasive is the value premium when compared to the local market returns and to growth companies, or the returns to growth companies. And what we find is that the value premium is not only included in the U.S. or occurring in the U.S. and Japan, it's pervasive across most of the companies or the countries. At least here with the book to market, the difference between the value and the growth companies, those that are high minus low book to market, is positive across all countries except Italy. The difference for high minus low earnings yield is positive for all countries except Italy, and high minus low cash flow yield is positive for all countries except the Netherlands. And then the high minus low for the dividend yield is positive for all countries except Germany, Italy, and Singapore. So we see that pervasively across most countries, for most metrics of value versus growth, the value portfolios tend to outperform the growth portfolios. And also what's interesting to see is that the value portfolios tend to outperform the local market as well. And we can see that here with the high book to market, and the U.S. portfolios outperform the market portfolio. There are a few where that doesn't occur, for instance, Italy. But in most cases, buying companies on average that have high book-to-market ratios outperform the local market, as well as their counterpart growth companies that have a low book-to-market. And we can see that happening with the other value metrics as well. For instance, higher earnings yield, higher cash yield, and higher dividend yields all tend to outperform the market portfolios pervasively across all countries except a few, for instance, maybe Italy. But one caveat to point out is that in parentheses, here in each of these cases, this is the standard deviation of the returns for that portfolio. So we see that even though in most cases when the higher book to market or value companies tend to have higher standard deviations than the market, and in most cases than their counterpart growth companies. So on a risk adjusted basis, this higher return for owning value companies might not be enough compensation for the risk that is being taken in each of these countries. And actually, the standard deviation of the global market portfolio that we saw in table 2 was about half of the standard deviations that we come about here in each of the countries. So in the next discussions, we're going to be analyzing, is this excess return that we get for owning value companies enough compensation for the risk that we're taking by owning those value portfolios? Okay, so now we're taking a look at table 4, where we're really getting into diving deep into the value returns and how they're affected and explained by various risk factors. And we have to remember that this paper was written back in the 90s when they're just starting to explore different factors and different models to explain returns. And so they don't have the different models. For instance, now they've got several different models, up to 6 factors in these models. So here they're still kind of pondering over the CAPM and 2-factor models. So what we have here is on this left side, we have the CAPM, which is basically how much of the returns of the portfolio can be explained by the market returns. And then over here on the right side, he's starting to explore how much of the returns to the portfolio are explained by value versus growth factors. And we have that factor here. So let's kind of take the CAPM on first. This is a model where we have an alpha figure here, as well as the market beta here. And in this table, we're explaining, or we have the coefficient for each of these. The A is here, the B is here. So this model would tell us that with the B coefficient here, then if a change in the market return happens, then how much of the portfolio's return changes due to that change in the market return. And then whatever can't be explained by this market return and its beta comes down into this alpha figure here. And so the author's first goal with this CAPM is to find out, does the CAPM formula provide good explanatory power for the returns to each of these portfolios that they've built? And if it doesn't, then is the solution to add another factor related to the value and the growth returns to these portfolios. So let's dive in here. We have the high book to market, high earnings yield, high cash yield, high dividend yield, and then the complementary low for those. So up here we have the value portfolios, and then down here we have the growth portfolios. And so first, let's take a look at the B, and this is the coefficient on the market factor. And we see here that the value portfolios tend to have a lower than 1 market beta, and growth portfolios tend to have a higher than 1 beta on the market. And so if the market were to go up, the value portfolios don't go up as much, and vice versa for the growth portfolios. But what the authors are really wanting to get at here is the results of this alpha figure here. We see that the alpha is pretty high. These are monthly returns, so monthly basis point of over all of the value portfolios, about maybe 33 basis points per month that aren't explained by the market return that would be here in this B. And we see here that the T statistic for the alpha, the T of the A, is very significant. Significant would be something that's above 2. And we see here these are very significant T statistics. And so this would mean that it's likely this alpha figure is not 0. And so then that would mean that there is something that's happening within these portfolios that are causing these excess returns that we can't explain with it just being because the market went up or down. And so that's why or the authors have created this regression over here, is to find out what in this alpha can be explained in another regression. And so they've added to this regression, which was A plus B of the market. We have the A plus B of the market there. And we've added C of the high minus low book to market. So the return of value companies minus the return of growth companies here. And we saw in the prior tables that the returns to value companies are higher than returns to growth companies. So we want to see how much of the excess return here, this R minus F of the portfolio, can be explained by them just being value versus growth. The first thing we want to emphasize here is that this alpha now is very, very small. And in fact, the T statistic is below 2 in most cases. And so we might conclude that it's likely that this alpha figure is 0 for each of these high minus low, or for each of these portfolios. And so that means that the majority of the returns, or the variation in the returns to these portfolios, can be explained by just the market and the difference between the value and the growth factors. And so when we add in this value minus growth factor, the market betas get a little bit closer to 1, it seems. And so in general, changes to market returns have a 1-to-1 relationship with the change to the return of the portfolio. And so then our major new finding here is that this C is a lot larger than it was before, or rather, it makes up a large part of the return now. And in fact, we see here that the T statistic of the C variable is very, very large. And this regression, since R squared is almost 100%, does a pretty good job of explaining the variation in returns for these portfolios. And so we're finding here that internationally and on a global basis, there's possibly a common risk factor related to value versus growth companies that cause excess returns that aren't captured by just the market. All right, so next we're going to take a look at Table 5 here. Back in Table 4, we looked at the regressions of the CAPM and a 2-factor model as it relates to the global portfolio of countries and stocks within those countries. But now the authors have split the global portfolio into the individual countries, and they've also split those countries into 3 different portfolios. The first one is, and these are the dependent variables of this regression, into the country return minus its risk-free rate. Also, they formed portfolios in each of the countries based on the book-to-market value, so high book-to-market companies within these countries and low book-to-market companies within these countries. So this will be value stocks in each of these countries and growth stocks in each of these countries. And then this one has overall all of the stocks in the country. And so we're performing the same analysis as in Table 4, where we're using the CAPM here, which is just regression on the market return. And for these purposes, this is the global market return. So we're looking at how much of these country returns are explained by the global market return. And then over here, as we had in Table 4, we've added in the global high minus low book to market. So how much of each of these countries' returns is explained by the global value minus growth factor and the global market return. So let's dive into the data here. As we saw in table 4, we have an alpha figure plus the beta of each of the factors, and then some t-statistics to tell us how statistically significant each of these variables is. And it's the same thing over here for the two-factor model. So first for the table with the country returns, we'll get down to the value stocks and the growth stocks here in a little bit. But first, taking a look at the country returns, we see that the alpha figures are somewhat small for the CAPM formula, and actually the t-statistics of the alpha are pretty small as well. So we could say that the global market return does a pretty good job of explaining the returns of the individual countries, because it's likely that this alpha figure is close to 0, and that leaves only the market return as the explainer of these returns. And we see here that a t-statistic for the beta is higher than 2 in most cases. So it seems that this CAPM formula does an okay job at explaining or rather the global returns do a pretty good job of explaining the country returns in each of the countries. However, we've got a pretty small R squared here relative to table 4, where we saw R squareds up in the 90% areas. And so having said that, if we come over here to the two-factor model, we see that the alpha is somewhat similar to the alpha used in the CAPM, and the t-statistics are pretty small as well, just like they were in the CAPM formula. And everything is, so it seems that everything is pretty similar between the two-factor model and the CAPM model. So by adding, it seems like adding this high minus low book-to-market factor here doesn't necessarily improve the explanatory power of this regression from the CAPM. This is when we're looking at the country returns overall, and even our R-squareds are about the same here with the two-factor model as they were with the CAPM. However, coming down here to the high book-to-market as the dependent variable, actually let's use a snipping tool here to make it a little easier to see this. Okay, so here we can see that when we're using the two-factor model as opposed to the CAPM model, our alpha figures have significantly decreased. Whereas here the average was maybe 0.5 per month, 50 basis points per month. Return was just from alpha the figure that wasn't explained by the global market returns. But here the alpha figure has decreased to maybe 15 basis points per month, and we see the t-statistic is far below 1 in all cases. And that leads us to believe this alpha figure is 0. So then that means if this is 0, then the global market return and the global high minus low book to market return explain the high minus low book to market returns within each of these countries. Therefore, this two-factor regression significantly improved on the CAPM regression here. And so this tells us that as the global returns to value increase, so do the returns to value within each of these countries. And so going down to the low book to market portfolios that we have here, we see that CAPM does a pretty good job of explaining the returns to the growth stocks within each of these countries. Since we have fairly low average alpha across all of these, as well as the t-statistic being below 2, although we've got some really low R-squared, so this entire regression doesn't do a real good job of explaining the variation in returns of the growth stocks in these portfolios. And so in the same analysis, by adding in the value factor here, which is the C, we don't get much of an improvement in the R-squared. And alpha is still about the same as far as its magnitude and t-statistics. But what's really interesting to see here is that the C variable on the value factor is positive, which is opposite to what we might think, because these are portfolios of growth stocks in each of these countries. So then if this factor is the global returns to value stocks minus growth stocks, then we would expect this C to be negative, because as the spread between value and growth stocks increases, we would expect the returns to growth stocks to decrease. And since there's something a bit off about that. Maybe there's something, some other factor that explains these returns better than the high minus low book to market. And we remember from table 1, the global market is composed primarily of the US and Japan. 75% of the market is composed of those. So these remaining stocks represent a very small piece of the global market, which is where we're getting this the global high minus low book to market factor. So the idiosyncratic risk within each of these markets is probably not completely explained by just the market and the value factors over the global market. And we see that here with these lower R squareds. Okay, so next we're going to take a look here at table 7. And for this, they've wanted to do an out-of-sample test. We know for the prior tables, we looked at developed markets. For example, the US, Japan, UK. But for this, they're going to look at emerging markets and perform a similar study. So we see that we've got the years here, usually about 1987 to 1995. We have several different emerging market countries: Argentina, Brazil, Greece, Korea, Mexico, Pakistan, Philippines, Venezuela. And so they've, as we saw in the prior tables, they've done some of the same tests where they have, this is the market return of each of these countries, as well as in parentheses is the standard deviation of those returns. And so here we have the high book to market. So these would be the returns of the value companies, the top 30% of book to market ratios in each of the countries. And then the low book to market, these would be the growth companies. And then the difference between these two here, the high minus low book to market. And then they've done the same thing with the earnings yield here. So earnings divided by price. So high earnings yield would be value companies, low earnings yield would be growth companies. And then they've done the same thing with small minus big companies. So we've got the returns of the small cap companies versus the returns of the large cap companies in each of these countries. And each of these figures in the brackets is the T statistic, which would tell us whether or not this difference that we have here is significantly different from 0. So normally, if this figure here is below 2, or the absolute value of 2, then we could say it's likely that this difference between these two is 0. If it's below 2, there's likely no difference between the value companies and the growth companies as far as their return goes. Anyway, so now we kind of understand the way that this table is structured. We see that most countries have a value premium. Brazil had a significant 73% difference between the high and low book to market, although Colombia and Argentina had the other way, with growth companies outperforming value companies. Nigeria has a significant value premium here, in the Philippines and Venezuela. We see here when we look at the market returns over here, this comes at a significant cost of a very high standard deviation of returns that we see here in parentheses. But the authors note that the correlations between the returns of all of these countries is very low. So if you were to combine the returns of each of these countries into a portfolio, you would significantly reduce the volatility through diversification. And it's interesting to see how much higher these market returns are in the emerging market countries. As we saw in the prior tables, the U.S. market is closer to maybe 10 or 15% per year, but Argentina gets up to 65% per year excess returns. So it's a big difference. And of course, the standard deviation is much higher as well. The U.S. standard deviation is maybe about 15%. So these emerging market countries have significant excess returns, but also significant excess standard deviation. But we can see how much of that standard deviation is diversified away when looking at each of the indices and where they have smaller standard deviations. And in continuing looking at the indices, we see that the value premium is very significant across when we combine all the countries together in these value-weighted or equal-weighted indices. So the value companies tend to outperform the growth companies on average. And we also see that happening over here in the earnings yield section as well, although it's not as significant as the book-to-market rankings. And of course, as has been noted in other studies, smaller companies tend to outperform larger companies by a significant amount. Although we do have some pretty small T statistics here, which would prevent us from concluding that it's likely that this difference is more than 0. And that's partly due to because we have such a small time period here. And authors note that maybe if they had a longer time period, and if the emerging markets aren't so volatile, then we would get some more significant T statistics here. Although the book to market difference here is statistically significant, but the earnings yield and the size premium is not.